Are you stuck in a job and are trading time for money? Then listen up now. Major investment banks are now predicting a US recession in late 2025 into 2026, which will lead to many job losses and an unstable income for many Americans. So now is exactly the right time to start saving and start investing wisely. Crypto has proven to be the most lucrative investment over the past decade, so it's a great avenue to get started. And to top it off, what if crypto can earn you money while you sleep? Today, we'll cover the real ways people earn passive income using their crypto holdings, and also exactly what risks to watch out for. I'm Marcus Lutz, I'm a longtime crypto investor, and I help high earners grow their wealth through cryptocurrency. So let's dive in. What exactly is passive income? Passive income is an income you receive without doing anything. So you can go about your day, you can go work at your job. In the background, your money is working for you and generating you an income. In crypto, it looks exactly like this. On the one hand, you can generate profit, which basically means you can hold high quality coins, Bitcoin and selective altcoins, and your selling price will be higher than your buying price. And this is how you generate profit in crypto. On the other hand, you can also generate income. And this basically is a yield by using stable coins and other crypto coins in the decentralized finance space. And both of which I'm teaching in Beyond the Market through the Core and Vault method, a time-tested crypto investment strategy which combines high growth asset, basically the core crypto assets, and the Vault part of the portfolio, which brings stability and passive income to your crypto portfolio. And now let's talk about the specific crypto passive income methods we have. Number one, we have lending and borrowing just with normal banks in traditional finance. We can provide liquidity to decentralized exchanges or short dexes. We can qualify for airdrops in your portfolio. As crypto and decentralized finance space is still quite young, there are a lot of arbitrage opportunities where you can exploit the inefficiencies of the crypto market. We can do trading and copy trading strategies or staking. And most of them are very passive, with the exception of trading and copy trading, which is semi-passive. So let's focus on number one, lending and borrowing. This is basically automated lending and borrowing companies or digital banks which offer fantastic yields for lenders as well as for borrowers. In most of these banks, there is a threshold of a maximum of 80% LTV ratio, which means a loan to value ratio, which basically means if you deposit $100, you can only borrow $80 against it. And there is an automated liquidation. So if in crypto, as there often is a lot of volatility, positions like this can be liquidated. And contrary to popular belief, this is very good for you as a lender because you want your money to be safe. And due to these automated liquidations, ensuring that no person has a higher loan balance than their deposit balance, this helps you as an investor keep your money safe. And lending and borrowing primarily works with stablecoins, and this is also good for you as a crypto investor who wants stability and passive income, because stablecoins are pegged one-to-one to the US dollar, any other fiat currency in the world like the euro, Mexican peso, you name it. You can earn exceptional yields with these stablecoins. And the yields generally range between 5 to 15%. And I know this is a big range, but it depends, of course, on the macroeconomic conditions we have at the moment, as well as the specific digital bank that you're using and the framework that is selected. And here are some screenshots. We can see 9.6 for USDE, we can see 10% for USDC, or here even 12.3% due to a Binance promotion for a USDC deposit. And 12.3% is absolutely massive. This even outperforms the S&P 500 over a long period of time without the volatility. Again, stablecoins are packed one-to-one. The second option of passive income is providing liquidity to decentralized exchanges. How this works is that you provide a crypto and or a stablecoin pair to a decentralized exchange and you earn a share of the transaction fees. Again, because it's decentralized, it's no single entity that controls everything or controls all the fees. So you as a crypto investor, you can put your cryptos to work. So let's say you own Ethereum as well as stablecoins. you can earn a fantastic yield, in this case here 41.2% per year in fees of your deposit. So basically if you deposit, let's say $10,000 into this liquidity pool, you can expect to earn around $4,000 per year in passive income, which works out to be around $350 per month. And this is extremely powerful because the yield is exceptionally high. However, there is a catch, and the catch is impermanent loss. So basically, long story short, what works best providing liquidity to decentralized exchanges are pairs that are correlated to each other. Basically, where the price action works in a range, basically bouncing off of support and bouncing off of resistance. So over the long term, the value of each asset stays the same. If you have a very volatile pair, this can become dangerous, and I'll show you exactly how. But if you know how impermanent loss works, you're actually ahead of 95% of investors, so you can use it to your advantage and actually print a lot of fees. And this is the example impermanent loss. Here we compare having $10,000 in stable coins on the left-hand side and 20 Ethereum, and we compare the state before the liquidity pool and after the liquidity pool. And then we compare this after the liquidity pool state to just holding the coin. Basically here, what we have is you provide $20,000 to the liquidity pool, of which being 20 Ethereum at $500, and after the liquidity pool you earn roughly $15 in fees, so like a very short period of simulation. However, it was a volatile period and Ethereum gained 10% in value from $500 to $550, and due to this fluctuation your balance in the liquidity pool of the $20,000 shifts, and afterwards you're left with $20,991. And of course this is great because it's more than what you had when you put in. However, you have to think about what would have happened if you just held the coins in your wallet and not earn any fees with that, and that would basically come out to $21,000, so basically roughly $9 more, and you wouldn't have had the hassle of doing a liquidity pool. And that's just to show that impermanent loss can work against you with volatile pairs. It's best to look for correlated pairs that have a high APR, and then you can really earn a lot of money. Again, being in the range of 40 to even 60% annual return is really not unheard of. That's what we have here with the impermanent loss. Let's look at the third option to earn a passive income through crypto, and these are airdrops. Basically, when new crypto company starts offering services, they want to incentivize early user engagement and participation. So the company promises these early users an airdrop, similarly to an initial public offering with a company on the stock exchange, an IPO. Crypto companies do ICOs, an initial coin offering. But before they do that, they usually have a pre-mainnet launch where they beta test the features, the platform, etc. And in order to get users on the platform to get hype attention on this new crypto product, they incentivize early user participation through an airdrop. And when you use that service, especially in the early stages of a new project, you will qualify for airdrops, and in the end coins will be sent to your wallet by the new crypto company once their ICO is live. Here is a screenshot of one of the biggest airdrops that we had in 2024, which was Hyperliquid, now a top 15 cryptocurrency, and the median airdrop amount was $28,000. Absolutely incredible. So early user participation definitely paid off, and in a case like this, the percentage return on the capital used for that specific airdrop was definitely in the double digits, if not triple digit return on an annualized level. So very, very powerful, but only in the right project. In this case, you have to do your due diligence because oftentimes airdrops are not really profitable for your time and money input. However, sometimes they're extremely lucrative. And the fourth way of earning passive income in crypto is arbitrage. And basically this is different lending and borrowing rates across platforms, and you as the user utilizing this inefficiency in the market. And this often happens during promotions, so take these promotions and use them to your advantage. Here's an ideal scenario. On Suiland, Solana, the Solana borrowing rate was minus 0.29% for a long time, and right now it still sits in the 2 to 3% range, so very, very low. And this is due to a promotion that Suiland is running. So in this case, you actually even paid to borrow Solana. And if you go to a different platform, in this case Loopscale, a newly emerging project which also still has their airdrop as an additional reward, which is amazing. And here, by depositing Solana in the Sol Genesis vault, you can earn up to 8.4% in addition to the airdrop, which you will receive at a certain point in the future. So by just exploiting this inefficiency in the market, you can basically gain 10 to 15%, if not 20%, depending on how high the airdrop is going to be, completely for free and risk-free. Here you can earn roughly 9% by just exploiting the inefficiencies in the market, in addition to the airdrop, which will probably be in the 10 to 20% return range as well. So with this simple task of this arbitrage model, here you can generate a return of roughly 20%, which is absolutely incredible. All right, let's talk about trading and copy trading, the more semi-passive aspect of the 6 ways when it comes to earning passive income in crypto. During certain times in the market, leveraged trading can be a useful technique to generate additional profits. And this is also called sometimes swing trading, which basically means at a certain point in the market, you can place an additional amount of money on your educated thesis if you think the market is going up or down from a certain level. Here, close risk management is important, and a stop loss, of course, to make sure that your liquidation and your loss potential is capped. And here, centralized exchanges like Binance or DEXs, so decentralized exchanges like Hyperliquid, offer leveraged trading, often under the name of futures or perps. And due to the transparent nature of crypto, copy trading wallets is also possible. So you can identify the most profitable wallets on the blockchain and just execute an AI bot which copies exactly the same trades that a profitable wallet does. So that's also a very powerful strategy, one that I can dive into deeper in case you want to hear more. And before we talk about the 6th most powerful way of earning a passive income in crypto, I would highly appreciate it if you like this video, hit the thumbs up, subscribe to the channel, and benefit from a lot of crypto knowledge. And number 6 is staking. So here we're depositing specific layer 1 coins to earn rewards and secure the network. And great examples here are Solana, Ethereum, Hyperliquid, and various other coins. And these assets are used in a proof of stake model to ensure the validation of the transaction on the blockchain. And this is a very powerful way because this is often the coins that you hold anyway, for example, Solana and Ethereum, and you can earn a beautifully passive yield by just holding them long term. And those are generally also good assets to hold long term. With the compounding effect of the passive income, it is very powerful. Just note that the yields here are not as high. They're generally around 5% for staking. So don't expect too much. However, I guarantee you it will add up over the long term, because with the price sensitivity of crypto assets, in addition to the yield generation, you can earn a lot of money. So let's quickly talk about the risks, because there's no such thing as a free lunch in the universe, so you need to know the risks. And the main risk here in decentralized finance is the smart contract risk, which means that people can exploit this smart contract where you send a transaction to a decentralized digital bank, and that bank basically holds your funds in a wallet, and this can be exploited by hackers if there is an inefficiency in the code or some sort of wrong mechanism on the platform. For this, you should specifically consider due diligence in a selection of companies to use in the decentralized finance space, so focus on established players only. Look for proven track records and notable backings of new projects such as Coinbase Ventures or Binance Labs or any other major venture capital firm in the crypto space, and only use companies which have at least a liquidity of already 100 million and above, because this signifies that there's a lot of trust in this specific company and your money is comparatively very safe with that company, and also your part of the pool will be very low. So basically your deployed capital or liquidity in specific pools should never exceed 1% of the total deployed liquidity, in my opinion, because otherwise you run the risk of illiquidity, and during volatile periods there can be slippage on your position, which you don't want. So definitely consider these small but effective hacks and due diligence frameworks for your decentralized finance journey. And with that said, we have covered the 6 ways on how you can generate passive income in your crypto portfolio, as well as the risks you need to consider. Please subscribe to this YouTube channel and hit the thumbs up. See you in the next video.